Just before we go to commodities market, Zimbabwe plans to issue new notes and coins soon to replace the country's quasi-currency that was introduced 3 years ago in a failed attempt to counter a crippling shortage of cash that has pushed inflation to the highest rate since 2008. The finance minister, Michule Nkube, says the return to a fully fledged local currency exchangeable outside the country's borders will be backed by an undisclosed amount of foreign exchange reserves, gold and loans. According to him, it first needed to compile data on the country's reserves before commenting on how much foreign exchange will be used to back the new currency. And South African supermarket chain ShopRite Holdings has missed full-year forecasts hurt by inventory shortages at home and currency devaluations in the rest of Africa. ShopRite is recovering from a poor first half when sales and profit were hit by a strike at its largest distribution center at home and installation of a new enterprise IT system which disrupted supply chains. In the rest of Africa, currency devaluations and forex shortages in markets such as Angola, its biggest operation outside South Africa, have made it difficult to operate profitably elsewhere on the continent, touted as the next growth sport for retailers. And South Sudan has made a new crude find in the northern oil field of Ada and plans production by the end of the year. The oil will be linked to the nearby Haluk oil fields that are managed by Dar Petroleum Operating Corporation. Ruined by war, South Sudan is trying to recover by resuming crude production. Output has increased to 180,000 barrels per day from 130,000 barrels per day during its 5-year civil war. And U.S. President Donald Trump has downplayed talks of a recession after his economic advisors say growing fears are unfounded. However, issues of trade war and Brexit have continued to rock the markets, including the commodities market. Well, let's bring in Adesola Simoni, one of the research analysts with Financial Derivatives Company, to look at this development for us on the commodities market update. Adesola joins us from the UK. Hello, Adesola. Good afternoon, and thank you for joining us. Now, there is a growing sense of anxiety about the likelihood of global economic slowdown. Do you think that a slowdown or economic recession is now imminent in 2020?
Thank you for that question, Chimeze. I think it's very imminent, and I think that the anxiety is not surprising. I mean, if you look at the Q1 19 figures for the global economy, the economy expanded at the slowest pace since 2012. And if you combine the slowing economic growth together with softening inflation in advanced economies, it points to the fact that the global economic activity was slower than expected in Q1 2019. Also, if you look at the multilateral agencies, the World Bank, the IMF, OECD, OPEC, they've all downgraded their growth forecast for 2019 and 2020, citing significant downside risks, including the US-China trade conflict, as well as the increasing probability of a no-deal Brexit. Now, if these risks materialize, it's going to significantly dampen consumer and business confidence. It's going to weaken business investment and consumer expenditure. It's also going to dislocate global supply chains, and overall, these factors put together are going to cause a significant drag on global economic growth.
So what will the impact of this economic downturn be on the Nigerian economy and, of course, the domestic commodities market?
The effect on the domestic commodities markets will be muted because of weak transmission mechanism. But the effect on the Nigerian economy, I think, is a mixed bag of positives and negatives. On the positive side, because of the slowing economic growth globally, central banks in advanced economies are beginning to adopt an accommodative monetary policy stance, and this, I think, will lead to capital flights from advanced economies to emerging market economies as investors we begin to look for higher returns on their investment. And if you look at the country like Nigeria, a benchmark interest rate is still at 13.5% per annum, and the yield on treasury bills is between 13 to 15% per annum, depending on the tenure. So I think we are likely to see an increase in foreign portfolio investments. Now, on the negative side, the slowing growth, may dampen demand for oil, may dampen oil demand. And even OPEC recently released a report where they downgraded their forecast for oil demand growth by about 40,000 barrels per day. And they also forecast that, in 2020, we're likely to see the market is likely to be oversupplied by about 200,000 barrels per day. So these factors would dampen oil prices, which might significantly affect Nigeria's projected revenue and budget performance. And I also think that the effect on the Nigerian exchange rate will be muted because of, we still have a robust foreign reserves of about 44 billion US dollars. And because of the central bank's frequent intervention in the foreign exchange market. So I think the effect on the foreign exchange market will be a little bit muted.
All right, thank you for your time, Desola. Desola Simoni is one of the research analysts with Financial Derivatives Company. And for updates on Nigerian equities market trading today, let's talk to Temple. Hello, Temple. Good afternoon. Well, the market started the week on a positive note yesterday. At intraday trading today, it was still green. So how sustainable will this trend be?
I don't think that trend is really sustainable, Chimeze. Yesterday, when we saw the market gaining some good figures, 0.71%, it was due to reactions of investor, a positive reaction, though, to the earnings of Zenith Bank. Zenith Bank had declared some 30 kobo interim dividends, and it was time for some smart investors to quickly take advantage of that particular yield. So that's why we saw that kind of interest yesterday. FCMB, which is a tier 2 bank, also released its earnings shortly before the weekend. It was Monday, so we saw some investors also reacting to that. Because again, if you look at FCMB, it's been down year to date by some whopping percentage right now. So we saw some positive reaction across the banking stocks yesterday due to earnings season. That's why we saw that kind of growth. But going forward, we don't think anything that is really, really sustainable. If you look at what also happened yesterday across the counter of Nestle, Nestle was down by 10% on Friday. Yesterday, it dips further. But today, we're seeing it revamping. However, if you look at a couple of other counters, they've experienced serious decline in recent times. So generally, we know that the market has been experiencing some kind of weak sentiment in recent time, and that is what is going to continue to rule in the market, given the factors that we have in the external factors and the domestic factors. The fact that we have crude oil still spinning, that's not helping matter. We also have the issue of VAT. We have the issue of FX ban on food importation. All of that is making investors to move out of the consumer goods markets, consumer goods sector, because that is where you have a lot of the food raw materials related to food, related to staple foods now are really, really needed.
Well, let's continue to hope that things eventually turn out to be good, particularly when the ministers eventually take up their offices and begin work. Thank you for the update. And on that note, we draw the curtain on today's edition of the program. Thank you for watching. I'm Chimeze Obi Iwago.